We always hear that the stock market is this perfectly efficient machine, right? That every single price is correct. But what if that's not the whole story? What if there are these hidden corners, these overlooked companies where there's real value just hiding in plain sight, pretty much, because no one's even bothering to look? Well, today, let's go find them.
So let's just ask it straight up. Is every stock price really correct? I mean, we're all taught to assume that a stock's price reflects, all the available information out there. But is that always true? What if some prices are wrong, not because of some random fluke, but because the system itself is kind of designed that way?
Okay, just picture this for a second. On one side, you've got the huge mega cap stocks, right? They're under this intense microscope. Thousands of analysts crawling all over them, dissecting every single headline. But on the other side, you've got these smaller companies that are basically invisible. They fly completely under the radar of those same experts. And it's right there, in that huge gap in attention, that the opportunities can start to pop up.
And that, right there, is what we can call the market's blind spot. It's this whole world where smaller companies, what we call small caps, they just exist far away from the bright lights of the mainstream, and that creates this really unique, interesting landscape of potential opportunities. And here's the key thing to get. When a stock price in this space is wrong, it's usually not a random mistake. Nope. It's because of these predictable structural problems, these inefficiencies that are basically baked right into the plumbing of the market itself. So what exactly are they?
Well, it really boils down to three big structural reasons why these companies are so often overlooked. And if you can get your head around these three things, you're holding the key to unlocking this whole space.
Okay, so reason number one is what we call the analyst coverage gap. It's kind of like the difference between a Hollywood blockbuster that gets thousands of reviews and a tiny indie film that gets maybe one or two, if it's lucky. In the Indian market, for example, once you get below a certain size, say under 5,000 crore rupees in market cap, a lot of these companies have literally zero analysts covering them. And even if some research does exist, it's often super old and stale. So the real story of the company stays completely hidden.
All right, the second big reason is liquidity. Now look at that number, 5 crore rupees. For a lot of these smaller stocks, that's how much is traded in an entire day. So imagine you're a giant mutual fund and you want to invest, say, 100 crore. Trying to buy into that stock would be like trying to fill an Olympic-sized swimming pool with a garden hose. It's just not going to work. You'd move the price so much just by buying that it's impossible. So you know what they do? They don't even bother.
And that leads us perfectly into reason number three. The big money is forced to sit on the sidelines. It's not that they don't want to invest. It's that their own rules won't let them. You've got mutual funds with limits on how much they can allocate. You have foreign funds, the FPIs, where their minimum check size is just too big to invest in a tiny company. And then you have the really big players, like insurance and pension funds, whose own risk rules basically forbid them from touching these stocks. So all these big buyers are absent, not by choice, but by force. And that creates a massive inefficiency.
Okay, so we've laid out the problems, the inefficiencies. The big question now is, how do smart investors actually hunt for value in this space? I'll tell you one thing, it's not about throwing darts at a board. It is all about having a systematic, disciplined process to find your way through this unique territory.
One really powerful way to do this is to actually create something called an inefficiency score. It sounds fancy, but it's just a practical tool. You basically take those concepts we just talked about, the lack of analyst coverage, the low liquidity, and you give them a score. Maybe you weigh the coverage gap at 40%, liquidity at 30%, and so on. What this does is it lets you systematically rank and screen for companies based on just how hidden or overlooked they really are. It's a game changer.
And this kind of systematic hunt is how you can find what some people call hidden champions. It's a process, really, with 4 key steps. First, you've got to identify a market leader, a company that's number 1 or 2, but in a really small niche market. Second, you look for its moat. Does it have some kind of protection like regulations or high switching costs for its customers? Third, and this is huge, you check the management. Are they good? Do they have integrity? And finally, you verify the numbers. Are the cash flows stable? Are earnings predictable? See, it's a whole process designed to uncover high-quality businesses that the big money players have just completely missed.
Okay, this all sounds amazing, right? But, and this is a really big but, it is absolutely crucial to understand that this is not some risk-free playground. The very same things that create all this opportunity also create some very real, very specific risks, and you have to manage them with extreme discipline.
You see, for every one of these opportunities, there's a risk on the flip side. That low liquidity, that's liquidity risk. It means you have to plan your exit carefully because getting out in a hurry can be tough. The lack of information, that's information risk, and it means you have to do way more homework than usual. The price swings, that's volatility risk, and the only way to handle it is with super strict limits on how much you invest. And finally, there's governance risk. The risk that the company's management won't treat you, the small shareholder, fairly. You've got to screen for that.
So how do you actually manage all that risk? Well, the first and most important rule is about position sizing. It's simple. Never ever put more than 2 to 3% of your entire portfolio into any single one of these small cap stocks. That way, if one of them goes south, and believe me, some of them will, it's not going to sink your whole ship.
And that brings us to rule number 2, which is about your total exposure. Your entire collection of all these small cap stocks put together shouldn't be more than, say, 10 to 20% of your total portfolio. Think of it like building a firewall. It contains this higher risk, higher reward part of your strategy, and it keeps the rest of your portfolio safe and balanced.
Okay, so let's start to bring this all together. What have we learned? Success in this corner of the market really isn't about getting lucky, not at all. It's about having a very specific mindset and a disciplined set of methods that are the difference between strategic investing and just pure gambling.
When it all comes down to it, success here boils down to a handful of core principles. You've got to focus on the systematic reason a stock is mispriced, not just on a gut feeling. You absolutely must be disciplined with your diversification and how much you invest in any one company. You have to be willing to put in the time to do the really deep homework. You build your position slowly, and this is so important. You plan your exit before you even buy. It's not about chasing the hot new thing. It's about patient, analytical investing. This is definitely not a get-rich-quick scheme.
So let me leave you with this one final thought. We're living in this age of AI and big data where it feels like everything should be known, right? Every piece of information should be priced in. And yet, as we've just seen, these deep, structural blind spots still exist. It really makes you wonder, doesn't it? Where else, not just in the market, but everywhere, do these hidden corners of inefficiency still exist, just waiting for someone who's willing to put in the work to find them?